Sure, someone requested or a video on a video on CRT in English. So what happens is uh, candle range theory. You are going to use it, or if I may say, I mostly use it to confirm my entries. It's more like a confirmation strategy. I don't use it in isolation. I use it for confirmations. And the question might be, how many strategies do I use, or do I have, or do I have knowledge of that I can use, or that I may use, or that I always use on my day-to-day trading? So you will realize that a majority of the times we are well equipped, or we have information, or there's quite a lot of information about smart money concept that you can use. That is one of the biggest entry model or setups that you're going to come across again. They are based more on your smart money concept. Assumption is you know what to look for most smart money. You have a price that will be pushing to one direction, if I may say. Let's say there's an uptrend, and then you're going to have a divergence where now the price fails to keep on breaking above higher highs, and in that case it means you're going to have a divergence, and then the protected low will be taken out. In this case, once you see the price doing this, you know that it might not keep on with the uptrend anymore, and now you have to come up with your break of structures, to the left, break of structure. Then you have your protected lows, or your protected lows are not supposed to be broken below. Once you see price taking out the protected low, you know that the price is seeking a reversal. So when you see that happening, you know you might have your order block at one point here. This will be your order block, or your point of interest, from which you know the price is supposed to come back and trigger people's buys or sells. So in this case, as you can see, you have an incomplete pullback. The first incomplete pullback resembles your engineering liquidity. Some may call it engineering liquidity, some call it inducement, but it is one and the same thing if you look at it. So from this incomplete pullback, the price might come back after some time in whatever the pattern. But basically what you're looking for is, at the end of the day, the price is to come in, mitigate your point of interest before it can keep up with the push to the downside. This is one common setup, smart money concept setup that you're going to come across. But as you know, above each and every order block rests liquidity. We have money above each and every order block, or below each and every order block. So this is going to be your liquidity pool, and you know the price is always seeking liquidity. It's always trying to move towards a point where you have a lot of liquidity, or where liquidity is resting. Now in this case, ignoring the fact that we have some issues around the liquidity grab or such things, you need to know that after the price, either it takes out liquidity above the order block, or it doesn't, but it just gives you a sweet tap and go entry like that. You need to know how to confirm your entries, and then this is where I'm going to use our candle range theory to indeed confirm that the price might sell. The first entry, remember I always say, the entry on the point of interest is your risk entry. Why is it the risk entry? Because you are not sure if the price will sell right away, or the price might mitigate your entry and then manipulate around your point of interest. This is a bearish setup. The same thing goes for a bullish setup. The price is trending to the downside, breaking structures. It leaves you with a change of character. I nearly forgot this one. This will be your change of character here. And then we'll have a pullback into the point of interest before the price can push up. It's the same thing for a bearish, for a bullish. This one is a common smart money model. Now, this is your risk entry at this point. Like I always say, the first entry is a risk entry. Why? Because the price might not just give you an entry right away, it might manipulate or maybe target losses, stop losses above the order block. Because you know, once the price target your stop loss, you lose your money, you are triggered out of the trade. And if the price keeps on to move in your anticipated direction, it's actually just a loss. So that is where the price, the range theory comes in. What does the range theory talks about? We are talking about three set of candlesticks which are supposed to occur around your point of interest or in the zone where you have your order block or your point of interest. These three candlesticks you're basically talking about, the first one will be a candlestick that shows accumulation phase, where the price is basically accumulating in one point. Then the second candlestick that we would mention is the candlestick now that is going to target your range high. So let's say this is your candle range high. If this is your candle range high for a bullish setup, this is your candle range low here. You have your range high, your range low, and then the second candlestick should be targeting the CRH. Our candle range high here should be taken out. This is your range high, and then below this is your range low. So this is your CRL, and if this is bullish, if the price take out your range high, that should be the candlestick now that represent your manipulation, your manipulation, because this is the same thing as your AMD concept. So the second candlestick will open inside the range. Say it opens inside the range, the buyers push the price to the upside, but later the price is rejected or sellers gain control of the market, then the price is going to be pushed back inside. And you know, when the price gets rejected from one point, it leaves you with a wick or a tail on that candlestick. You're going to have a tail from the upside. Now this is your manipulation candlestick. Why is it a manipulation candlestick? Because now it is taking out the stop losses, or it's taking out liquidity above your range high, because the price now targets a lot of orders above the range high and then it closed back inside. That is your manipulation candlestick, which is very important in the model that we are going to talk about. The third candlestick that you're going to get now will be representing your distribution, and this one is the one that we need to look for entries. So if you look at these three candlesticks, they should be forming right when the price taps into your point of interest. The whole thing that you see here should be forming on the area where the price taps into your point of interest. Now you're going to use these or this kind of a scenario to confirm indeed that the price might sell. That's the right way of using the CRT. What is the wrong way of using the CRT? If you have the same thing that you have here, three candlesticks, but the second candlestick does not close within the range, it is an indication that the price is not yet ready to reverse. Now in this case, if you see this your range candlestick, then the price opens within the range but closes above the range. If this candlestick open within the range, opens here and is pushed to the upside, and then the candlestick closes above the range here, this is not going to give you a reversal. It shows that the price is indeed still in is still moving towards one direction. So in this case, you cannot take this to be your range theory. Range theory only talks about when the candlestick that forms, it manipulates the high of the range candlestick. In that case, it's supposed to close back inside the range. We now have, or we are now going to be in a position to say the price might be seeking a reversal. Then on the third candlestick, you're going to be looking for a fair value gap. On the third candlestick now, on a lower time frame, if this is going to occur on your 4 hours, for example, your 4-hour candlestick gives you your range, the next candlestick gives you your manipulation, then the third candlestick gives you your distribution. This is your AMD concept. On the distribution candlestick, now we're going to go to a lower time frame. Anything below 30 minutes will be your lower time frame, and then you're going to use that for entries again. So as you can see, on the range, we're going to have a lot of candlesticks under a lower time frame, but the most important thing now is going to be your distribution candlestick. So we have your accumulation in form of a ranging market. Then the second candlestick is going to manipulate the high of the range candlestick. Now we're going to have a push to the upside, but later we see the price dropping back into the range, and then it's going to take out the range low. That is what you're going to get as your A for accumulation, with the candle on the left for me, M for your manipulation. The second candlestick that forms will be manipulation, because it is actually now taking out the high of the previous candlestick. And then the third one that is going to form is going to be your distribution candlestick. Now on the distribution candlestick, what we are looking for, we are looking for a fair value gap from which we can take our trade from. So what I was on about was the third candlestick, that we now have to identify a fair value gap on a lower time frame, where we are going to be taking our trades from. The fair value gap now does not give a guarantee that you are going to get an entry. You just use that concept to know that the price is supposed to come and rebalance the inefficiency that it left, and in that we know after rebalancing we can now look for opportunities, and then you can sell to the downside if it's a bearish market, but if it's a bullish market you can also buy to the upside. And using this information, you need to know that it is not used in isolation. You cannot just use this out of nowhere. It needs to be happening around a higher time frame point of interest. Say this is your 4 hours order block, and then you expect to see your manipulation candlestick tapping or mitigating that point of interest. The same thing will happen here, and then what you're going to be looking for is for the price. You're going to be looking for the price to retrace back into your distribution candlestick on a fair value gap, and then you can push to the upside. I think I mentioned this thing on the last presentation, that if you look at this model, sometimes you're not going to get a sweet entry. It's not, like I said, it's not a guarantee that you're going to enter and not have any drawback. If you know how the price move, you only know that we are reacting to what the price is showing us. We are not controlling, and you are not going to chase the price. If it gives you an indication that it might reverse, you need to have other confluences that you might use, or that you may use as confirmations that the price is indeed seeking a reversal. And in that case, you are not going to have so many complaints, because now you have the right knowledge and you know that such things do happen. So I'll take the very same presentation to the real chart, and I'll show you where this applies. So first of all, I shared the boom 600 sell setup yesterday. That is where it showed more. I also have a boom 900 setup. On top of that, I have a 500 boom 500 setup, where I saw this happening. And all of these three setups, we had an entry that didn't give us much problem. So the first one is going to be boom 600 on 4 hours, if not 2. 4 hours boom 600. I think I saw that somewhere. check 2 hours. And this is the same setup that I shared. I might just share the trade from my saved screenshot. So here, let me do 2 hours on the same thing. And right now we are sitting on a risk to reward of, it's almost on 85 to 90% before it reaches our take profit. So what you are looking at here is three things. First is an order flow, which is going to be a bit different from what I just talked about, but it's not different in the sense that our entry model is not the same. I explained using smart money concept, but this is the same thing under smart money. We are talking about order flow. So to start here, why did I think or why did I say that the price will drop to the downside from this reference point here? So erase all, remove all drawings. The first thing that you need to see, you should have your range candlestick. Your range candlestick should be surrounded by two other candlesticks. The first one should be your range high, which is going to give you your range. This is your CRH, followed by a range low, your CRL. And these are the two candlesticks which we need to use to tell if the price will drop or not. The first thing that you would see, we have an order block. I always say each and every week rejection has a story to tell. If you don't ignore such information, you'll know that every candlestick week shows something, and the direction in which the mass of the body of that candlestick is shifting towards also have a story to tell. If your candlestick is sitting right above your equilibrium point, right above 50% of that candlestick, you know that the sellers were pushing the price to the upside, the buyers were pushing the price to the upside. And if the body of that candlestick, more of it is below equilibrium, you know that now sellers were in control of the price at that certain period, and they were trying to push the price to the downside. That's the first thing that should be fundamental. You know, if the mass is too concentrated above 50%, buyers were in control. If the mass is too concentrated below 50%, using your Fibonacci tool, you know that sellers were in control. However, if the mass is around 50% of your candlestick, your candle open and candle close, if the mass is centered, we have what is called in this case, buyers and sellers are competing to push the price to a certain direction. This is what gives you your doji candlestick, and this doji candlestick is the one that brings about indecision in the price action. So going back to what I wanted to show you here, you can see that the mass of this candlestick is basically more above our 50% of the whole candlestick. And in this case, we have an idea that the price might be buyers were in control here. And this indecision, if you have a lot of time on your hands and you use that time to look at each and every candlestick that is presented, you realize that all of the doji candlesticks or all of the indecision candlesticks, they always push the price to one direction, or maybe it's a point of reversal in most cases. So this is the first point here. We have a point, the price came in to tap onto this point, and then it kept on dropping. As the price dropped to the downside, what does it do? It breaks structure below a protected low. So this is your break of structure or market structure shift. The price goes back into the range and then it drops. Now, like I said we have three candlesticks that we use as our reference, that indeed the price is seeking reversal. The first one, your accumulation, your manipulation, your distribution. Now on your distribution candlestick, we are supposed to look for what? For an imbalance candlestick. So this is my distribution. Let me mark it so that no one is lost. My distribution candlestick, and then I'll drop straight to 30 minutes, and on that time frame I'll show you what that is. So on 30 minutes now, this is what we get. On 30 minutes, this is what we get. Your distribution candlestick is the one that I marked here. It only shows 3 candlesticks. The first one is here, second one, and then the third one. Now on 30 minutes, we don't have any clear imbalance. I'll drop to, let me mark this again, and then drop to 10 minutes. And see what you are going to get under 10 minutes. You are supposed to be having a full imbalance candlestick, a clear imbalance, and that will be the one that gave us a sell to the downside. Very good. As you can see now here, I said, what is an imbalance candlestick? An imbalance candlestick, or an imbalance, is a price that shows movement towards one direction. We only have expansion towards one direction. That gives you your imbalance or the inefficiency. The price is not correcting itself, rather it is pushing to one direction. And the second candlestick, the one in the middle, is going to give you your, that is how to properly mark your imbalance, the second candlestick. And we expect to see the price coming back to retrace into that zone, rebalancing before it can keep on moving to one direction. So with that being said, we can use that information here. Your distribution starts on this candle. Now I'm going to use 3 candlesticks. The first one is here. This is the first candlestick, the second candlestick, the third candlestick. And I also said on the second candlestick, we need to see the price coming back to that space, rebalancing on that space, and then we can drop. As you can see, the price was moving to the downside, expanding, retracing back into the zone, and then it kept on with the downward movement. Hence we got an entry. And since you have your range high, your range low, you can target your range low for take profit, or you can use your draw on liquidity. And if you look at a lot of what these are, a lot of information that you get on online, either YouTube, TikTok, Facebook, a lot of these people are gatekeeping, in the sense that they don't give out all points that you need to know about. That is why these guys sell their mentorship lessons. They'll always tell you what mentorship. No information is free. If you ever get to come across free information, I believe the same they are willing to share what they know with you. But a lot of these guys are in business by selling the PDF, by selling the mentorship, and you pay a lot in a less time. So if you look at it today, you can tell that CRT should work in conjunction with something. You can't use this in isolation. Plus CRT, it's like you are looking for something in a place where it doesn't exist. So that is the first example where you have a take profit hit. Let's look for another on boom 900. Boom 900, I have a setup that is running, also approaching take profit. And this one I shared yesterday. We nearly hit take profit. Nearly, I think it's a difference of risk to reward. We have 176 pips, and we are only short of 9 to complete the whole setup. So what did I see here is the same thing that we had. Point of interest. Now we are going to go to the entry. I'm on 30 minutes. I'll drop to 10 minutes, if not 15, to show you how the price did tap into the point of interest. So you can see here you have your accumulation. This is the accumulation. Accumulation or price move sideways. Accumulation. Your manipulation. Now the second candlestick that forms is going to wick above. If in this case it's a bullish market, it is going to take out the high of the accumulation, and then the distribution candlestick it's all from that manipulation is similar to drop out to the downside. That is going to be your distribution. And distribution ke gone ha re batlang entry teng gore re bone gore a price e tla dropa kana nya. So let me just get rid of this and show you how the price managed to drop from this zone. So we have here the first candlestick. Again, this is your accumulation phase, manipulation phase. Remember that 30 minutes come at 10 so the first 10 minutes nearly candle bullish, the second, the third one nearly agar. Now our distribution is similar. Distribution is similar on this candlestick here, but the entry on that candlestick. So this is 10 20 30 10 20 30, and on this distribution you can see that we use a fair value gap on a series of 3. A fair value gap, which is the second candlestick, gives you an entry, and how let's say the price never went to the upside. It has been pushing ever since this point, and I shared this one if you check, I think it is 2 previous videos that I recorded and sent. This was the entry, take profit, draw on liquidity. If you know external liquidity, external range, your ERL and your IRL, here we are creating external range liquidity, and if the price does manage to break below this draw on liquidity, take profit, hit, was not trading, that's it. So until we meet again on the next presentation, that's enough. Hit like, subscribe and share. If you share the knowledge, again it's free until mentorshiping, and you can't access any free information anymore. So until we meet again, ciao.